Good afternoon, and thank you for joining us for today's webinar, Q3 results and the road ahead. Not easy for me to say, apparently. My name is Sean O'Brien, president of QwickRate, and as always, I'm pleased to be joined by David Ruffin. David's going to handle the second part of today's discussion, focusing on credit. David's one of the co-founders of IntelliCredit, and is always bringing insights into these quarterly webinars. And then our third portion of the discussion will be led by Dan Marks. Dan's the president of Infusion Marketing Services. He leads our overall marketing strategies for the company, and he'll talk some consumer trends on the third part of today's discussion. We're going to cover again the QCBI results. As I mentioned, David's going to talk credit. Dan's going to talk customer trends. We'll take questions throughout. If you have any, certainly use the Q&A feature or the chat feature. We'll monitor those during the midst of the discussion and take them at an appropriate break or at the end of the discussion. Also, we will be sending out a link with the recording from today's webinar along with a copy of the slides. So thank you for registering and thank you for joining us today. As always, we're going to start with just a couple of polling questions to get started. Appreciate your participation. I think there's just two, but I'm going to go ahead and launch them. The first one's around 2026 priorities. Please rank your 2026 priorities as they stand. Select top three and bottom three. Just rank the order. So appreciate that. And we'll just give this 30 seconds or so. I think if you just hover over them, I think you can get the priorities. We're going to go ahead and end that one. We'll share some results. So again, kind of evenly split across the board. So again, we'll share these within the email that we send out likely tomorrow afternoon or early Thursday morning. And then the second question, just what are some of your key strategic initiatives for 2026? And you can multiple answer this one. So. And then secondly, what are some other key strategic initiatives for 2026? Here's a little bit longer answer. If you want to put something in or just put it into the chat, you can as well. Just anything that strategically you're focusing on for 2026.
Lots of operational process enhancements.
Okay, I'm going to share those. As Dan mentioned, efficiency is always at the top of the board. So operational process enhancements followed by digital banking or a newer credit or deposit system, and then CRM or analytic capabilities. So again, thank you for participating in those, and we will share those in our email as part of our follow-up. So again, thank you. Jumping into kind of the numbers, right? Really, again, for most of us, I think we continue to see, pretty strong bank performance kind of across the board. Loans and deposits continue to grow. NPAs still, kind of remain modest. Reserves are solid, and charge-offs at the median are still zero. And really, again, kind of across the board improvements to NIM, core operating earnings, pre-tax ROA, and ROAE. So, I think the feeling's pretty good. I think what's not to like. I think the only thing that, I think just as one of the polling questions suggests, I think deposits continue to be top of mind. Not that they're, tremendously, any pressure right now, but, I think for most of us, we continue to see good, decent loan growth. There's always a little bit of a funding gap. Right now, it's not dramatic, but I think just ongoing and going forward, right, we just continually feel, challenges because of the ongoing disintermediation from, a number of things. Many of these have been with us a long time. But, I think more recently, again, with fintechs, just, even online gambling accounts, lower personal savings rates, there just continues to be pressures, kind of eating away at our, a lot of our non-interest bearing deposit accounts. David, and I were discussing the stablecoin legislation. Again, I think that this is, again, just another piece that will potentially whittle away at some of our deposits. So again, I think just mindful of the fact that deposit gathering continues to be hard work for any number of reasons, the disintermediation, but just currently, inflation running higher leaves consumers with fewer funds, a slowing economy, oftentimes makes both businesses and consumers less willing to borrow, so they're going to use the available cash they have. When unemployment rates go up, deposits, usually go down. So again, just, a number of challenges. And then I think within our local marketplaces, a lot of times we are gaining or losing deposits really kind of in a zero-sum fashion amongst, other institutions in our marketplace. So again, not a new problem, but just continually and consistently, making it more challenging and more difficult. And going forward, deposit growth is really increasingly relying upon, marketing budgets, your branch network, utilizing digital channels, and then the hard work of your branch staff. As I mentioned, loan growth has kind of continued to grow. Again, a bit slower, but over the last 12 months, still a solid piece of loan growth across the board. Nearly a quarter of the community banks in the country saw greater than 10% loan growth over the last 12 months. So again, very, very encouraging. Deposit growth, again, better than it's been. Still slightly lagging, loan growth, but I think very encouraging from where we were just a couple of years ago. And again, I think increasingly, the number of institutions who are seeing deposit contraction, has kind of held steady and even declined to a certain extent. So, it still remains challenging for the $0 to $100 million institutions, but again, I think across the board, other than that, I think banks have been pretty pleased with the deposit growth. I think the story that continues to impress and I think help drive the earnings is clearly the ability to pass on higher loan pricing. Again, I think in our analysis of high performing banks, this has been a very correlating factor over the last couple of years. But increasingly, again, just shows the banks that are able to pass along these yields, higher pricing on their loans, continue to drive solid earnings. Again, I think nearly over a third of the banks greater than 7%. And then if you look at by asset size, again, really strong pricing performance across the board. Cost of funds we actually saw come down. Again, the $0 to $100 million banks have done a good job managing their cost of funds. Really, everybody has, but not surprisingly, you kind of have an inverse. The yield on loans, it's larger as you go down the size. Cost of funds goes lower as you go down the size, asset size of the institution. So, but again, really good management by institutions of all sizes. That's helped translate into a really strong increase in NIM this quarter and over the last 12 months. Again, realized and experienced across the board. Non-interest income has kind of stayed kind of flat. Again, not surprisingly, the $1 to $10 billion banks managing and clearly having the largest and greatest opportunities to drive non-interest income. The efficiency ratio, for the first time in a number of years, we saw a meaningful decline. And again, not surprisingly, the efficiency ratio highest at the $0 to $100 million banks. But again, improvement for really almost all institution sizes. But again, a meaningful decrease in the efficiency ratio this quarter and over the last 12 months. All resulting, as we mentioned at the top, really strong pre-tax ROA and core operating earnings for all institutions. Again, I think there's just nothing not to like in what we're seeing in pre-tax ROA and core operating earnings. Median ROA and return on average equity, again, really pretty good except for the 0 to 100. The only one not seeing double-digit median return on average equity, but from where we've been, really still a good story and good momentum as we enter the end of the year and into next year. So really pleased to see these numbers. I'm sure all of you are as well, and keeps us optimistic for the coming months. Again, just at the median and across the board, we always try to show this slide just so you can kind of get a spectrum a little bit. We focus on the median values, but I know we want to see not all of us are at the median, so you can kind of see the range of performance at percentile ranks. Just a reminder, these are available through QwickAnalytics at both the state and national level. So if you want to see them beyond the national ones and just see within your state, you can click and download the reports here, or you can email in, and we can certainly send them out to you as well. Okay, at this point, I'm going to turn the presentation over to David, and David's going to talk credit and along with some wholesale funding topics. All right, David, I can see your screen.
Okay, super. Thank you so much. I'm going to take a little bit of a more nuanced and regional dive into some of the data that Sean just shared, particularly as it relates to, well, yeah, I'm sorry. This is where I wanted to start. Sorry. So in terms of wholesale funding, we've kind of got bookends from the Northeast to the Southwest in both of these charts, both wholesale funding showing a little bit of decline as deposits have continued a little bit, although loan growth, again, as Sean indicated, not quite somewhat exceeding deposit growth. But in terms of gross loans to deposits, you see the same divergency between the regions in that regard. Sean gave a lot of very positive numbers, of course, about Q3 performance in the banking industry, and here comes the credit guy. I'm not here to in any way rain on that parade, but what I am absolutely dedicated to do is just kind of point some issues out that we think at least bear observing relative to credit. This probably is the most concerning trend that I see. We saw a bit of this at the end of second quarter, and that is the total NPLs to loans continues an upward trajectory, actually at a more pronounced sense than we even saw at the end of the second quarter. And contrast that to under $10 billion banks in terms of their reserves to in other words, what reserves are they taking or towards their inventory of NPLs. As you can see, that goes in the opposite and divergent way. And again, if we get into significant credit stress, that trend will obviously have to turn, particularly for the community financial institutions, in terms of putting more reserves in it. The more conventional way of looking at the allowance for credit losses to loans again shows a fairly large disparity among the regions. You've got the West at 150, almost 150 basis points, the Northeast at relatively 1%. You might remember the Northeast banks were the ones that had the highest loan to deposit ratio as well. So I think that's an interesting little tidbit. Texas ratio, again, which is is the simplified thumbnail indicator of credit problems relative to the capital you have to manage those credit problems, has continued to show an upward trend, particularly during the last couple of years. And many of you've heard me say this many times before. It has a disproportionate impact on smaller financial institutions, largely due to their reliance on real estate and the reduced capital base. As far as the more traditional real estate concentrations, we see the Southwest and the Southeast a little higher in construction and development. You would expect that among the Sun Belt states due to the population growth and potential for more economic activity. But I will say, and the broader 300% guidance, which is is really kind of flattened out. I will say though that for the last 3 quarters, we've seen a decline in both of those measures, a little bit, not significant, in terms of beginning to reduce some heavy concentrations in real estate among the under $10 billion banks. So again, multifamily, again, still some increasing in that. There is some continued indication that multifamily is providing a little bit of a challenge out there due to some, particularly in certain markets, of overbuilding supply and what have you. And again, that tends to be the inverse of the mortgage industry. Whenever mortgage rates stabilize and you get a more stabilized, wonderful family mortgage industry, typically multifamily is on the other end of that spectrum. C&I continues to decline a little bit. Ag, of course, the Midwest banks naturally are going to lead heavily in ag and farm lending. I use this quote again, which I think we all understand. We've been, from Jamie Dimon, we've been in arguably, certainly in my long career, the longest credit bull market that we've ever been in, to my knowledge. And we also know just human nature is that once that credit cycle does turn, then you probably have a proliferation of some credit issues. Again, I'm not here to say that that's likely or is indeed going to happen, but I think those of us that are in the credit risk management business feel like we have to certainly be sensitive to any kind of tea leaves that we're beginning to see in that. Some of those we've talked about in previous quarterly reports. The uncertainty continues. When I speak to conferences, which I do quite frequently, I always use polling, and the consistent theme remains uncertainty in terms of credit and, frankly, the economy. One of the things that I think is beginning to emerge, that particularly some of the credit practitioners are observing, is this so-called K-style economy that we may be moving into, where the more paycheck to paycheck versus the more well-heeled borrowers are showing disparate credit performance traits. Speaking of disproportional risk, I think we still have that CRE concentration that with community banks, and there's beginning to be some empirical data that's showing the tariff impacts, and we all realize that is changing sometimes fairly frequently as to what the policy is on that, but it's particularly beginning to affect some small businesses. And as it relates to credit quality, that's certainly something for bankers to keep an eye on. I mentioned this, I think, a couple of quarters ago, but when I attend conferences, I still discern this, and that is there seems to be a divergent sentiment among bankers, particularly in the roles that they're playing, whether they're in more executive C-suite positions or between particularly the credit operatives that are working. The latter group seeming to have a little more concern about some of the trends they're beginning to observe in the industry in a sense of negative credit quality. The risk grade migration, the one big thing I would like to share with the audience today is we're seeing more and more banks kind of lumping in low pass risk grades into one large category. I feel like that, at least experience-wise, that when we've been through credit cycles, that once we get into some credit degradation, it is unwise to have to go through and ferret out in a very large pool of credits. In other words, in an attempt to claim to be more conservative, you may be impractical in terms of then you have the challenge of trying to really figure out who are the more stressed credits. So and certainly we're seeing in our loan review work, we're seeing more downgrades. Most of them are into low pass, as yet not into criticized classified categories. Speaking of the regulatory, that seems to be the key as well in terms of more credit process versus transactional credit risk criticisms. I do think it's appropriate to talk a bit about the changing regulatory landscape. We certainly knew at the change of administration there'd be a major philosophical change around the CFPB. That's obviously occurred. Many of these regulatory changes appear to be, frankly, good news, if you will, for community financial institutions or smaller financial institutions, purportedly approving M&A deals a little more quickly. They've already officially removed reputation and climate change risk out of the kind of the CAMELS or the overall assessment of bank management. There's proposal to lower the community bank leverage ratio from 9 to 8%. There's every indication that comments have been made that there are more streamlined and fewer regulations for non-systemic banks ahead. But that leads me to the last point, and that is what is clearly the case now is due to various factors. The regulatory community is down. For example, on the OCC, an individual from the OCC shared that they may be down as much as 40% in resources. That they may be good news for some people. My thought, however, is, and the comment was made by this OCC gentleman that indicated that they may be forced into far more so-called superficial reviews or drive-by examinations of banks unless they're showing very marked credit or other performance deterioration based on call report or public information. Again, at the face of that, that might seem to be good news that you don't have to have, massive hordes of regulators coming in your bank, staying for extended periods of time. But the truth of the matter is that I think is that all of us, whether we're vendors or whether you're managing your own banks, it's incumbent on you to manage your own profitability, your own risk protocols. I think we may be actually moving into an era where you're going to have to kind of dust off that sense of your own ability to run your bank, particularly with trusted vendors and the risk protocols. I would not be surprised that we don't see some fairly significant announcements in the near term relative to that exact point. We mentioned this last quarter, and again, I think it's incumbent to kind of emulate what the finance and funding people have been doing in the banking industry since certainly the 2023 mini crisis that we had, and that is start looking at some credit stress contingencies, policies, particularly focusing on industry and supply and demand profiles within the communities that you're financing properties. And of course, from our perspective at IntelliCredit, enhancing the use of and dependence of what we call the 3 pillars of post-banking credit risk management. Certainly portfolio analytics, understanding better your non-public loan data, which is your DNA, unique to you. Certainly enhance loan review. Make sure loan review is your partner in assessing risk. We have a huge bias of using technology, but also incredibly seasoned reviewers who can be persuasive if need be, and understand the qualitative part of credit, which is unique to just the quantitative part. But today, I'd like to focus primarily on the third leg of that pillar at IntelliCredit, and that is stress testing. We're a huge believer in doing all you can to kind of start putting stress test and loan review in kind of the same mindset, have them complement and potentially even be concurrent to each other. And where I'm going with that is that stress test obviously is a theoretical exercise. I think it's why a lot of people are just, considering, well, we have to do it, but what does it really give us? It's just a theoretical exercise. But hopefully, for whatever means by which you do, particularly loan level stress testing, in this particular depiction, we of course differentiate it based on loan product, such as a multifamily or retail. But in most cases, hopefully, you're getting beyond the theoretical stress. You're getting explicit list of who are the credit borrowers in your bank that may be upon the realization of the theoretical credit stress, may be ones that you have to keep a closer eye on, such as current annual reviews, and make sure they are incorporated, frankly, into the loan review samples that you are doing periodically. In this particular case, this would be part of the what we call the stress loss drivers, those that are added to the more traditional scope candidates that you see on the right, such as concentration, covenant violations, delinquencies, and the like. Remember, again, all of this is just hearkening to that old axiom in banking, and that is early detection gives you typically fewer losses. I'd like to close with for this segment, with one concern that I have sensed is growing out there, and that is the growth of private credit in the U.S. economy. I've done as much as I can to research a fairly objective chart here to the left showing, and it's basically inclusive of bank C&I and bank CRE, which obviously make up the bulk of commercial purpose lending at banks. They are the top charts there, but you can see the equivalent of that is in private credit. But the thing that, and it's doubled roughly in the last 5 years. The Fed now estimates it's about 12 to 15% of commercial borrowing in the U.S. economy. But as you can see, even projected through the year 2030, the projected growth of that is actually higher than commercial bank lending. One of the concerns I have in this is frankly, and at the face of it, many of you bankers could say, well, why am I caring about this? They're actually taking higher risk deals off of our table or out of our pipeline. And yes, that is a risk mitigant. But my concern is the more broadly systemic nature of what potentially could happen. As we all know, one of the great accelerators of credit cycle changes is the acceleration, almost a panic that goes into problems once credit is acknowledged to be under significant stress. My biggest concern is a lot of the private credit are not being analyzed in deep ways like bankers do. In many cases, I frankly think they take more of a Wall Street analyst approach in terms of more performance, short-term performance, rather than the true credit analysis that those of us in the banking industry are used to. But again, there's also been some fairly recent bankruptcies, and there's clear evidence that some of these private equity groups and private credit dispensers have very large guidance lines at megabanks, which could begin to start, as I indicated, some kind of a systemic approach. Again, I would like to close by just saying all of this is more in the nature of being cognizant of these issues, keeping a closer eye on them. It's not by any stretch of the imagination a statement that we're heading into heavy credit stress. We just don't know at this particular point in time. So Sean and Dan, I'll hand it over to Dan at this point. Again, thank you so much for allowing me to join you again.
Yeah, thanks, David. Always very insightful. And, to your point about just shifts in the environment with whether or not it's private credit or stable coins or what have you, there's always something going on. So just as a little bit of a reminder, the infusion perspective is we work on a very granular basis with really community-focused institutions all across the country. We have marketing clients in over 27 states. We have generated over 25, we're actually up to $26 billion of balances for clients using very specific analysis that unpacks customer opportunities and then monetizes those opportunities through targeted programs. And so really the unique perspective that we offer, besides being a bunch of ex-bankers having spent some time kind of in the chair, is the data assets we refer to as the infusion norm. And it's really two different related data assets. One is a customer focus that understands the intersection of product and service usage for both consumers and businesses across over 50 million households, and really how they use the financial products and services that we sell as bankers every day, in kind of a macro perspective. And so we're going to pull out some insights from that for this conversation. Related, we also, because we do specific campaign work with banks and credit unions, we have millions of records of when we have a specific communication for specific needs, whether that's deposits or loans or payments or business or consumer, customer onboarding, acquisition, different points in the life cycle, a unique combination of audience, message, offer, and channel mix. What is the output, or what is the result? So when a bank were to specifically reach out to a customer or prospect with an offer, what is that result? And we compare, and so we'd be able to track that. In fact, we have over $26 billion of results that we've tracked. That kind of macro picture and the specific campaign performance really lends itself to some, we believe, useful insights. We rely on a lot because when we work on a marketing basis, we work on a pay per performance where we invest in the outcome that the bank wants to drive and only get paid when we create that outcome. So obviously we have to be very predictive so we don't lose our shirts. So that's the insight that we're drawing upon for these comments. And I think one macro picture, just to continue the theme that we see from Sean and David, is we're obviously in an interest rate cutting cycle right now. The odds are dropping for a December rate cut. Last time I looked, it was certainly better than even I believe the first time I looked at the December futures, it was over 80%. Well, as of yesterday, the futures markets are only pricing in a 42% chance of a rate cut, which may have something to do with what's happening in the equity markets right now. But nevertheless, so whether or not this is a sort of a slow, gradual slope down or a faster slope, when we look back in history at every major rate cutting cycle in the last 50 years, the deposits tend to grow in that cycle. Right now, sometimes it's after. In fact, if you look at the zero line, there's only been one point in time in the last 50 years where deposits in the system have not grown year over year, or are actually declined year over year. I guess there's been a point in time where there's been a little bit of no growth, but there's actually only been one point in time when there was actually decline. That was sort of post the pandemic bubble, as liquidity was coming out of the system. So in one sense, that's really good news from just a demand, since that's the inventory that we are relying upon to fund the business. But I think the other thing is it certainly tends to be slower growth, sort of coincident with and following rate cuts. So it's getting tougher, and we would expect it to to get a little tougher to generate those deposits. When we look at what's happening on a household level, so this is consumer household checking trends, checking, of course, being really the primary anchor point of a consumer's individual lives. And there's been a lot of literature about, does a primary relationship still exist? Is is Gen Z or whatever letter we're on right now opening? Are they have they demolished the idea of a primary financial institution? Are they using Chime and PayPal and Venmo and Bitcoin as well as their bank, or not? But when we look at and some of that's actually happening, but the core checking account is necessary to be a primary provider. And we so when we look at what's happening on an average household level, we're seeing the really an elevated deposit balances per household for checking. So when we look at total checking, its most recent quarter is $12,400. That's down a little bit, on the order of $100 from earlier this year, but really the decline that we saw as rates started rising has equalized and is fairly steady. And then on the interest checking side, we are continuing to see kind of a tick up in terms of average balances as banks have started paying some interest on those checking balances. People are keeping more in that interest checking account or collection of interest checking accounts in the household. And so really robust average balances at the household level. In terms of consumer CD trends, we're seeing an ongoing march up. So really in the last just 2 or 3 years, the average balance held by households that use CDs held by CDs is up almost 10%. So as rates have risen off of the zero floor, CDs are becoming attractive again, and certainly amid all the uncertainty that was talked about, that's a very attractive kind of midterm vehicle for consumers and even some businesses to use to manage their liquidity. And so we're seeing ongoing demand for CDs and usage at the household level. Money market average balances have been a little more steady. So for households that use money market, we're seeing an average of $81,000 across the board. Again, this is of using. And then a slow, sort of steady march up in terms of penetration rate. Again, when nobody was paying anything on deposits, didn't really matter if you kept your liquid funding in a money market or a checking account. But as banks have paid funding or have started paying rates again on money market, there's been a resumption in the growth of penetration, but still a relatively few people on average use money market when you think about an average penetration rate. So other forms of savings are still more prominent. High yield savings is probably some reason for that, just as the distinction between money market and savings has become less clear in the consumer's mind. Some of the regulatory changes, we are seeing kind of a growing interest in high yield savings, whether or not from a bank or an online provider. When we look at, so those are kind of macro household behaviors. When we look at what's actually happening on a campaign response rate, there was a huge boost in demand in the 2003 time period and really stretching into 2024, where there's sort of pent up demand. So we were seeing, on average, 5, 6, 7, even 7% response rates on CD campaigns in that 2023, 2024 time period. But they're reverting down to the mean. So the long-term average response rate we see for CD and interestingly enough, very similar money market savings campaigns is a 2% response rate. We're seeing response rates for CD campaigns kind of revert towards that long-term average. Same story with money market, although money market saw a little bit more of a bump in demand in the late 2024 period and 2025 with just rates. It shouldn't have anything to do with the fact that bankers were lagging deposit rates on the way up or not, I'm sure. But so the good news is there are granular growth rates available when you want to get organic customer deposits using the right data and targeting, using the right communication approach. You can be very targeted in raising funds in pockets of customers where it makes a difference, right? So you don't have to chase hot money and sort of advertise huge rates to everybody. You can get some base hits in a way that builds customer relationships, relying on data, not rate. And we see that there's a long track record of doing that. Switching to the other side of the balance sheet, I'm going to talk probably more about consumer credit than business credit, just because that's where a lot of the angst is in the industry. Certainly outside of some of the things that David mentioned on CRE, but I would say from a household behavior, the consumer is holding up very well. So we're seeing nice measured increases in home equity balances. So this is primarily lines, but does include any fixed term loans. So we're seeing, a nice measured increase in the average balances held, and then still, at least at banks, a relatively modest amount or modest penetration rate of people borrowing against their house. Obviously, this is true home equity products. This would not include mortgage and refinance. But certainly as rates have risen, using a home equity to tap into the equity of the home and not having to refinance the first has become increasingly attractive. And I would say, very, very moderate behavior, but and really some nice balances. So the nice thing about a home equity, of course, is it's got that the security factor. Looking at credit card trends, and so this data is from community banks. This would not include the monoline, right? Obviously, I would guess probably, over 60% of people, if not 80% of people in America have a credit card with one of the monoline national providers, whether or not it's, Cap One or Chase or Citi or Amex or what have you. But we're seeing nice usage of credit cards, although people tend to be more likely to get a credit card from their credit union than their community bank. Now, some of this may reflect the fact that it's more common for credit unions to actually have a direct relationship, even on an outsourced basis, and hold those loans in their books. If a bank was using a referral relationship, that we wouldn't see that credit card on their balance sheet or CIF. But still, it's much more likely for someone to have a credit card with their credit union than their local community bank. And then when we look at response rate trends for just general consumer loans, we do see response rates higher at credit unions than banks. So it's a credit union tends to be have about a 2% response rate for consumer credit campaign. A bank tends to be more in the 1% or a little bit below or 1% rate. Now, what's interesting though is the average balance is about twice as high for a bank. So the bank tends to be a lot more real estate secured credit, and then the credit union tends to be, unsurprisingly, probably a lot more unsecured and auto secured lending. And so those, there's a consumer dynamic at play there. But there's demand out there. One of the things to think about when you're looking for quality credit growth that also enhances the customer relationship is we've seen over and over again asking for the business but being proactive, right? So as people are coming in the branch less and less for daily transactions, they're using direct deposit or technology for their deposits and their transactions. It becomes that much more important to proactively reach out to them to help them understand what solutions you have to their financial needs and services. But it's there, and it can be very methodical in getting a base hit to meet those needs. And you can see from these charts that when you reach out, people respond. So if you're interested in taking a deeper dive into your customer base, we do a tailored opportunity assessment. We dig into these kind of metrics and many more and understand just where the pockets of opportunity and risk from a customer perspective, a customer growth perspective, attrition and acquisition opportunity. And so there's a little bit of information there. We'd love to talk to you about it. Chat us in the chat, or please do reply to the email, or just reach out to either myself or Trevor Knott, our Chief Revenue Officer, if you have a desire to talk more about that or explore or see how it can help you out. Love to do it. All right, Sean, back to you.
All right, thanks, Dan. So again, if you have any questions, final questions, go ahead and submit those now in the chat or the Q&A. Again, I think final thoughts, looking forward to closing out the year strong. As Dan, said, right, it's just getting a base hit every day, keep fighting for every one of those deposits. And then as, kind of echoing what David said, just remain vigilant in your efforts to continue to manage your credits. Early detection always is going to mean fewer losses. So let's just keep what we've been doing, which has been great through 2025. And we'll look forward to seeing you on the next quarterly webinar. Again, I don't see any additional questions or chats. So David or Dan, any final words before we let everybody go?
Well, we're kind of closing out the RFP season for next year in loan review. We'd be honored to have any of the banks to request a proposal. We certainly would love that and be honored to engage that process with you. Great.
As Dan has the slide up there, right? IntelliCredit can help you both with loan review. And again, as David touched on, we do have a digital solution, the portfolio analyzer, and stress testing capabilities available. So certainly reach out if we can help you on any of those. On the next slide is as I touched on the analyzer, we certainly offer you a 3-month trial to get introduced to that. So take advantage of that. And then finally, if tomorrow we have an upcoming webinar, Jennifer Manning from Presidential Bank is going to talk about how she uses QwickAnalytics at her bank. So as always, please register for the webinar. Even if you can't attend, you will receive a copy of the slides and a link to the recording. So let me just check here. Again, I don't see any questions or that. Thank you all very much for joining us. Certainly look forward to, hope you all have a happy Thanksgiving, and we will catch up again in the next quarterly webinar. Thanks so much. Have a great day.
Thanks.
Thank you.